Hi, this is Steve from cimabtc.com. In this particular section, we're going to look at the currency futures market. So before I actually dip into the currency future, I'd like to talk you through a little bit about the futures market. So the futures market is one of the derivatives we can use to hedge against the risk. What this actually means is, if you look at it in this way, you can use a simple rule to summarize the futures market is bet on what you are afraid of. So what this actually means is you can do some futures in the futures market in relation to the oil, rice, etc., or currencies, interest rates, anything you want. So from that perspective, so let's have a look at this example then. You're afraid that the oil price would rise. Okay, so from that perspective, you enter into a futures contract relating to the oil price. So let's say today's price for the oil is to be $10. Okay, you're afraid that the prices of the oil will rise from $10 to $20. And from that perspective, so actually, in 3 months' time, I can tell you that the oil price is $20, not $10 anymore. So from that perspective, in the actual market, originally you can spend $10, but now you have to spend $20, so that you spend more, which is $10, so you make a loss. But from the futures market's perspective, because you're afraid that the prices of oil will increase from 10 to 20, and now the price of the oil has increased from 10 to 20. From that perspective, you are right. Okay? So you are right, and another party entering this particular futures contract with you would lose his money because he bet that the oil price would decrease. So that's why he entered into this particular contract. But you think that the price of the oil will increase, so you win this contract. So from that perspective, that the price of the oil will increase from 10 to 20 so that you can make a gain of 10 in the futures market. But what does that mean? Well, if you look at it this way, you're afraid that the prices of the oil will increase from 10 to 20. From that perspective, you will lose $10 if you're not going to enter into the futures contract. But entering into this particular futures contract, you can use the gain from the futures market to set off against the losses in the actual market. From that perspective, although the prices of the oil has increased from 10 to 20, but you suffer no losses. Okay, so this is what I mean by futures market. So many people who use futures market, especially for the multinational companies, to hedge against the risk. But some of the people in the world would like to enter into the futures contract not to hedge against the risk, which means not to use the gain from the futures market to set off against the losses, but rather they're going to forget about the actual market. They have no oil on hand at all, but rather they're going to enter into a futures contract to bet with someone else to earn some money from it. Okay, so this is how the futures market may work. I can tell you that the futures market, let me write it here, that the futures market is very much the same like the forward market. But as you can see from the early study, that the forward market, it is the OTC, which is the over the counter, which may mean that there will be a counter here. I'm dealing the transaction with someone over the counter, okay? So which means two parties dealing with each other. So from that perspective, for the forward market, of course, quite normally, it will be the perfect hedge. And of course, for the forward market over here, that the dealing, which means the transaction, it is not standardized. And also because it is dealing one person with the bank, one person with the other person, and from that perspective, it will run a risk of default as well. But for the futures market on the left-hand side, because the futures market would normally be traded in a recognised exchange, and such as in London, it is the London International Financial Futures and Options Exchange, and from that perspective, it is almost the same like the shares in the London Stock Exchange. Shares are standardized, and also futures contracts are standardized as well. So from that perspective, of course, it is easier to enter into the contracts within the futures market. You just buy or sell of one particular standardized contract quoted in the exchange, rather than negotiating with the bank, okay, of one particular transaction. And of course, because of its standardized nature, which means, well, maybe you're going to hedge against $1 million, but the contract size of one particular contract within the futures market is just to be $33,000, for example. So from that perspective, 1 million divided by 33,333 can give you only maybe, I don't know, 30 contracts, 30.3 contract. You need to use 30.3 contracts to hedge against the total amount, but we can't say that 30.3 in the exchange. We can only buy or sell 30, okay, in full numbers. So from that perspective, it would normally be the imperfect hedge for the future contract. Of course, because it is dealing within the exchange, recognized exchange, creating lots of transactions day to day. Think about it in this way. If you buy your shares, will you be afraid that the company will default on the payment? Well, the answer is no. So from that perspective, there will be less risk of default. Okay, from the futures market perspective. So this is the basic knowledge behind the futures market. Okay, basic knowledge. So what we're going to do now is to have a look at the currency futures market. Okay, so how does that work then? So it is the same as the general futures market, to be honest with you. Firstly, you need to open up a futures account in the exchange and ring up the brokers, or you can buy or sell the futures contract on your own using the software or on the websites. That will be no problem. You can buy or sell the contract, isn't it? But before that, the exchange will require you to put in some money just in case you default on the payment, which means this will be called margin. So the exchange will require you to put in, so let's say 2% of the total transaction you're going to enter into. So for example, is to be, let's say, just make an example, is to be $5, which means, well, this will be the initial margin. That will be no problem. And how the futures market will work is that we are going to set them daily, which means, well, if you are in the day number 1, you can make a profit of $4 profit, so that your margin account will become $9 on the day 1. Fine. On the day 2, you make a loss of $6. So from that perspective, your margin account will become $3. So you can see here, $3 is less than the initial margin. So what the exchange is going to do is to require you to put in an extra of $2 so that your margin account will become the initial margin, okay, as agreed. So this would trying to reduce the risk of default. So, and also you can see here that if you make a further profit of 10, so that your margin account will become 15, isn't it? If you make a loss of 20, from that perspective, your margin account will be 5. So that you need to put additional money to make the margin equal to the initial margin, which means you need to put up another 10 so that it will remain at the initial margin level. Okay, so this is how the the futures market may work. And let's have a look at the currency futures market. And before that, I'd like to tell you a little bit about the futures market. The futures market, the general futures market, that you can buy or sell the futures contract at 4 particular dates. It is usually at the end of the month of the March, June, September, December. Okay, 4 dates over here. Of course, you can enter into the March futures contract, which means the final deadline for you to set to this particular futures contract is to be 30th March. Fine, but you can of course set to that contract before that date. Okay, so you enter into a futures contract, a March futures contract, and the deadline for this is to be 30th March. But you can of course set to that futures contract before that date. Okay, any date you want before that date. Okay, but the deadline is to be 30th March. So this is the logic behind it. So when talking about the currency futures market, so it will be very much the same as the general market over here. So the idea will be almost the same. Okay, and the steps I'm going to teach you to tackle any of these exam questions in the P4 exam is these 3 steps. Okay, so firstly, we'll set out the CPA, okay, for the overall outcome of it. So first C stands for consider the actions. Either you're going to have a receipt or has a payment. And also, this will be in the home currency. So what this actually means is you're going to receive $2 million from the customer in 2 months' time. Fine. So from that perspective, you're going to receive that money from a foreign customer of $2 million, but you are in the UK, so the home currency will be the UK pounds. Fine. So you need to translate those $2 million into the UK pounds using the spot rate in 2 months' time. Because we are showing the outcome, what is the actual receipts of payments you're going to make. Okay, but since we are going to use the futures market, so that's why we need to calculate any profit losses as a result of entering into this particular futures market. So in the second step, P over here, we need to consider the profit or losses in the futures market. And always this will be in the working number 1. So how are we going to do that then? So let's start up a working number 1 over here. Profit losses of the futures market. So we're going to take that the profit losses per future contract multiplied by the number of the contract and multiplied by the size of the contract so that it can give us the total profit losses here. The question is how we're going to calculate the profit losses per futures contract and also the number of the futures contract as well. So we're going to start working number 2 and working number 3 in relation to those. So, starter work number 2 is that we are going to calculate the profit loss for future contract. How are we going to do that? Of course, we're going to set up a table here. So the table we're going to set up is that now settlement date and also profit losses. And we're going to take the spot rate minus the future rate giving us the basis. So the basis is just the difference between the spot price and the future price. Nothing more, to be honest with you. And why does that basis exist? Is that, let me give you an example here, that this will be the spot price and the futures price. We're going to, normally in the real life will be greater than the spot price. But at some point in the future, they will be the same as together. You can think about it this way. If I'm going to go to New York from the UK and you're going to go to New York in the HK, fine, we have the final destination, which means we're going to meet together at some point in the future. But I'm going to go to New York by plane and you're going to walk to New York from HK. So from that perspective, I am faster than you. Yes? Such as in this case. So this is the logic behind it. One other example I give my student is that for the spot price, think about the gold. If you're going to buy the gold today, fine, you buy the gold. If you're going to buy the gold tomorrow or maybe in 3 months' time, maybe the prices will rise because after you bought that gold, you need to suffer some inflation. Maybe you need to borrow some money from the bank to buy the gold at some point in the future. And you need to pay the interest expenses. So from that perspective, that the future price will be greater than the spot price. So here what I mean by that is the differences between the two would be the basis. And you can see that the basis will become less and less and less. And finally, the basis will equals to 0. Okay? At some point in the future. Another way to think about this is that at some point in the future, is futures here, fine, futures here, spot rates, are there any futures rates on that date? Well, the futures rate will be the same as the spot rate at that date. Yes, the future, at this date, there's no futures anymore. Yeah, you can think about it like that. So we are going to set up this table here. We're going to set up now is now, now, and the settlement will not necessarily be the deadline to settle this particular futures contract. But normally in the exam and also in the real world, because we are going to receive $2 million from the customer in 2 months' time, we'll enter into a 3-month contract. We are not going to wait for the 3 months before we actually settle that 2 months receipt. But rather what we're going to do is that at the point of 2 months, we're going to settle that amount. Okay, so this is what I mean by settlement date. And one minus the other, giving us the profit losses. One minus the other, giving us the profit losses. Okay, so we are going to use the spot rate minus the future price, giving us the basis here. And then basis, we're going to estimate what is the closing basis will be. And once we are told that the spot price at some point in the future, of course we can use the spot price minus any basis, which gives us the future price. So normally in the exam, you need to estimate that future price based upon the basis given by your examiner. Fine. So this is about the working number 2. What about the working number 3 then? It's the number of contracts. Number of future contracts. The number of future contracts, we're going to take the amount. What do I mean by amount? Well, it is the amount we are going to receive or pay, yes, but it needs to be in the contract currency. Divided by the contract size. Okay, simple as that. So we are going to have a look at an example just to see how this will be fit together. So we're going to look at the example called simple PLC in your study notes. Okay, so this question is called simple PLC and requires us to show how to use the future hedge to this transaction. So if you can see in your example, of course, the first step you're going to do is to try to plot in my pro forma here. So I'm going to show the CPA, consider the action. Either we're going to receipt or pay, profit loss from a futures contract, working one, and actual receipts or payment, if you like. And here it is the home currency, just to bear in mind. Okay, because you're calculating what is the actual receipt or payment from your perspective. So that's why we need to use the home currency here. So let me start with working number 1. It's the profit loss from futures market. We're going to calculate the total profit losses here. So what we're going to do is to try to take the profit loss per futures contract multiplied by the number of futures contract multiplied by the size of it, giving us the total profit loss. And the profit loss per futures contract will normally be in the working number 2, and this will be in the working number 3. So working number 2 is the profit loss per futures contract. This will be in a table. That's no problem. In the exam, you just write this down, okay? And it's quite professional to do so. And now, and the settlement, and then profit losses. So you're going to take the spot minus the future, giving us the basis. Okay, so working number 2, this is working number 2. And working number 3 then is about the number of contracts. The number of contracts, we're going to take the amount, which is in contract currency, or in short, is called CC, divide by the contract size. Okay, so let's see how it can be fixed together. Okay, so let's say this example here. So now is 4th May 2013. So from that perspective, of course, the first information we're going to slot into the pro forma is to be now 4th May. Okay, now it's to be 4th May. Fine. Tick that off. And a UK company will receive $2 million on 10th June 2013, which needs to be converted into the UK pounds. So let me see here. So we are in UK because it's the UK company. So from that perspective, that the home currency into the CPA over here is in UK pounds, isn't it? So we tick that off. We receive $2 million. $2 million is the what? It's the foreign currency, isn't it? So we're going to receive $2 million. So that, consider the action, we're going to receive it, okay? So we are going to say this is the receipt, okay, fine. So another one will be, is to be $2 million, so write that off, write it down, $2 million over here, okay. On 10th June 2013, so from that perspective I told you before, we can enter into the futures contract in 4 days. We can enter into the March, June, September and December contract. In the real world, it's up to you. Enter into whichever contract you like. But in the exam, we are going to assume that we're going to enter into the contract just to be, for example, this one is to be 10th June 2013, so that we're going to enter into the June's futures contract, because the deadline for that is to be 30th June. And in the real world, of course, you can enter into the September's contract or December's contract if you like, really. So from that perspective, this is the conversion date, isn't it? Because on this date, on 10th June 2013, we're going to receive $2 million, needs to be converted into the UK pound. So from that perspective, that in the settlement date into your working number 2 over here, your settlement date would be your 10th June. Okay, and of course, we're going to see here that the contract price here is pounds to dollar, and we're going to enter into the June's contract, which may mean that $1 equals to 0.82 pounds. Fine. So we're going to enter into that contract price. Okay. So forget about it. So let's read the scenario now. So in order to lock into the spot rate, then the UK companies think about to use the currency futures contract to hedge against the foreign exchange rate risk. So here's the logic. Why do we use the currency futures contract? Is that the aim of that is that we need to make that the actual receipts of payment by entering into the futures contract and considering the futures spot rate would be approximately equal to the receipt to payment if we were to convert that using today's spot rate. So this is the aim of the futures contract. And how are we going to do that? Of course, we are going to lock into the futures price, which is this one, 0.82. But how are we going to do that? I'm going to show you that later on when we come to it. Okay? So this is the logic. So also we are posing the question that the contract price is to be, we can see here, quite interesting, is to be $200,000, which means the dollars here would be the contract currency. And in some of the textbook, it's called CC for short. But why are we provided with that? Of course, we're going to use this figure to calculate the number of contracts. So this is the first one. And the second one would be, in any of your futures contract questions, you need to convert all of your exchange rates. So for example, the exchange rate over here is pounds per dollars. You need to convert that exchange rate to make that the second currency would be the contract currency. Okay, so in this case I do not have to do that, okay, because we are told about this. And also, for the spot rates, you can see here, to make our life that much easier, I've done that for you. Which means, I'm going to make that the second currency for the spot rate will be equal to the contract currency. If this is the case, we are going to slot this number firstly into our working number 3 over here. So you can see that we are going to receive, let's say it's $2 million. $2 million is in dollars, is the contract currency. So we don't have to adjust for that further. But in some of the question, it will not be the contract currency. So for example, the contract currency will be the UK pounds. And from that perspective, we need to convert that amount into the contract currency by adjusting for the opening futures price. Okay, so in this case, we do not have to do that. Divide by the contract size. And we have told the question that the contract size is to be $20,000. So that 1 divided by another, giving us 10 contracts here. So that this will be the working number 3, isn't it? So we're going to slot that. Number is to be 10. And the size of it is to be $200,000. So I said to you before, we need to convert all of the rates for the second rate being the contract currency, which means the second rate would be the dollars. Why do we need to do that? Well, because here's the logic. If you can see the table here, it's the home currency, it's in UK pounds, isn't it? You need to calculate the profit losses from the futures market in UK pounds, not in dollars. So from that perspective, we need to calculate the profit losses per futures contract denominated in the UK pounds to dollars. So you can see here, the size of it is in dollars, and then netted off with the dollars, so that it gives us the total UK pounds for the total profit loss. So that's why I recommend you to do that in this way. It can save our life, and also it can make our life that much easier. Save us a lot of time. So yeah, here's the thing. Right. So just to write it off firstly. Okay. Just to write it off firstly, to make our life that much easier. So I said to you, we need to enter into the June's contract, okay, from the exam's point of view. So from that perspective, we're going to say 0.82 0.82. I have a question for you. Where do we put these figures to? Either now or at the settlement date. What do you think? Well, of course, we're going to enter into the contract now. Into the futures contract, okay, into the futures contract, into the June's futures contract of 0.82. So, another question. Either we're going to buy the contract or sell the contract. What do you think? Well, just to make it simple, let me give you a nice straightforward example before we actually move any further about the buy or sell. Let me open up a page over here. So I'm dealing with either we're going to buy the futures contract or sell the futures contract. And I'm going to use a very straightforward table to help you understand that. So, on the left hand side will be the home currency, which is in dollars, fine. Right hand side will be the foreign currency in the UK pounds, and you are living in the USA, so that's why your home currency is in dollars. Now I tell you that the contract currency would be in dollars. If I tell you that at some point in the future you're going to receive the UK pounds, which is the foreign currency, what are you going to do? If you're going to hedge against this risk using the currency futures contract. Well, am I going to say to you, well, if you're going to receive the UK pounds, fantastic. So what you're going to do is that because you're living in the USA, there's no point that you're holding too much UK pounds on hand to pay for the McDonald's, to pay for the hamburger in the USA, because they do not accept the UK pounds in the USA. So from that perspective, you need to sell that UK pounds to get those dollars on hand in order to purchase those hamburgers. So from that perspective, how are you going to create a hedge using the currency futures contract? Well, we are going to buy the future. So what do we mean by buy or sell the future is that buy the future is that we are going to expect the price of the underlying item, which is in here, in this case is to be dollars, to rise. Sell the future, which means we are going to expect the underlying item, which is the US dollars here, to fall in value. Okay, so this is the logic behind it. So let me give you an example here. So originally, that $1 will equals to 1 UK pounds, and I'm expecting it to rise up all the time in order to be $1 to 2 UK pounds. So from that perspective, of course, and enter into the contract now of $1 to 1 UK pounds, I can buy it, so that I'm expected to rise up all the time, so that I'm going to sell it off to make a gain of one, okay, as a result of this two. So this is the logic. So if I'm going to say I'm going to make a payment of dollars, of pounds over here. So if I make a payment of pounds, I am living in the USA, and from that perspective, I need to buy the UK pounds before we can actually pay in the UK pounds. But how are we going to do that? Of course, one thing we can do is to try to sell the dollars, so that we're going to sell the future. Because dollars here will be the contract currency, so that sell the dollars, which means sell the contract currency, sell the futures. Okay, so this is the logic behind it. But what does that actually mean? Well, if you think about it this way, now the dollars is to be can convert it into 2 UK pounds. I'm expecting that the dollars will fall in value will be dollars to £1. So from that perspective, on that date, on the settlement date, I'm going to buy it at this rate. I'm going to sell it at that rate, so that I can create the profit as a result of the two. Okay, so this is the logic behind it. So that's why we're going to sell the future. Sell the future, which means we are going to expect the underlying item, which is the US dollars, to fall in value. That's it. But in the exam, just don't complicate this issue, okay? Just to use your business common sense. If you're going to receive the UK pounds, the contract currency is in dollars, how are you going to do that? Of course, you're going to sell those UK pounds in order to get the dollars, so that you're going to buy the futures. Yeah, that's it. If I'm going to give you another example here, is that the home currency still will be the dollars, and the foreign currency is in the UK pounds. I'm going to tell you that the contract currency is in UK pounds, not dollars anymore. So from that perspective, you're going to receive the UK pounds. What are you going to do? Of course, you're going to receive the UK pounds, so that you are going to, because you're going to receive the UK pounds, right? But you're living in the home market, which is in the USA. So from that perspective, you need to sell off those UK pounds to get dollars. So that sell the UK pounds, and because the UK pounds here is the contract currency, which means you're going to sell the future. If you're going to buy, if you're going to not buy, is pay the UK pounds. Before you can actually pay the UK pounds, you need to buy the UK pounds. Okay, so that you can do that. Because buying the UK pounds is contract currency, so that you're going to buy the future. Okay, so this is the logic behind it. Quite difficult, really, to be honest with you. But if you know that, that'd be no problem. If you're If you don't know that, of course, that is not the end of the day. So, just to take you back from the simple PLC's example here. So let's read through the question again. The company is based in UK, fine, will receive $2 million and dollars is the contract currency. So from that perspective, you're going to receive a foreign currency. You're going to receive a foreign currency, but you're living in the home market, so that you do not need those currencies, so that you're going to sell off those currencies to get into your UK pounds. Yes? So from that perspective, either we're going to buy or sell those things. Of course, we're going to sell off the dollars to convert that into the UK pounds. So that sell off the dollars, and the dollars is the contract size, so that we're going to sell off the futures contract on that date. So here's the thing. Here's another question that many students get asked. Is that, well, 0.82. Are we going to sell off the currency today at 0.82, or are we going to sell off the currency at some point in the future at the settlement date? What do you think? Well, of course, the answer is we're going to sell off it on the settlement date, which is on 10th June 2013. You may have a question, well, since we are going to sell it off on the future date, why are we going to put this figure into today's column? Why are we going to do that? Well, the reason being, we are going to do that because we are going to simplify the issue, because we need to calculate the basis. We need to calculate the differences between the spot price and the future price, and then use that basis to estimate at any point in time what the futures prices will be. So that's why we're going to do that. So, this is it. And we're posing the question that the spot rate today is to be $1 to 0.8224 UK pounds. So from that perspective, of course, we're going to slot the numbers in here. Is to be 0.8224. Okay, so that one minus the other, giving us the basis over here, is to be 0.0024. Tick for that. Also, we are posing the question that the spot rate on the settlement date is to be 0.784. 0.7840, I should say. Fantastic. Tick for that. Also, we are posing the question. This would not be posing a question if you are in the real exam, but just to simplify this issue, I'm going to tell you this bit, is that the future price on that date is to be 0.7837. Okay. So this particular figure, the examiner will normally ask you to predict that figure would be, which means on that date, you're going to buy it at this and sell it at that. Okay, on this date, you're going to buy it at low, sell it at high, so that you're going to gain the profit out of the two. So that one minus the other, giving us the profit losses as a result of one particular contract, is to be 0.0363. Okay, and in the spot market, the exchange rate changes here. It's one minus the other, giving us 0.0384. Okay, so this is it, and we're going to use this one, which is the profit losses as a result of one particular futures contract. Slot that into the working number one, is to be 0.0363. Okay, so just to multiply by this altogether, so this would be here, giving us a total figure of 72,600 in UK pounds. So we're going to slot that figure here, 72,600. So what's the first step? Well, it's to consider the action. We're going to receive $2 million on the future date. So we are going to receive $2 million on 10th June 2013, which is the spot rate at that date is to be 0.784. So from that perspective, we're going to convert that into the UK pounds just to use the $2 million multiplied by this figure, because the currency here is in dollars and this is in the UK pounds, so they are different. So that convert that into the second currency, we're going to multiply by this altogether. First currency, we're going to multiply by this altogether. Okay, so I'm going to do is that $2 million multiplied by 0.784, giving us the total figure of 1,568,000. This will be the receipt, isn't it? So one plus the other, giving us the total receipt of 1,640,600. Okay, so this is how we're going to use the futures contract here. Final question I'd like to ask you is that at the start I told you that the aim of the futures contract is to try to lock into the spot rate, which may mean that we are going to make that the actual receipt of payments will be approximately the same as we are going to take the $2 million multiplied by today's spot rate. So which means, well, say that here, is that if I'm going to say, well, $2 million, convert that into today's spot rate. Today's spot rate, we are told the question is to be 0.8224, fine. If I'm going to do that, it gives us the receipt of 1,644,800. So you can see here, if I'm going to convert that $2 million in today's terms, I'm going to get the receipt of this figure. If I'm going to use the futures contract, it will be very close to the receipts calculated here. Using the futures contract, how are we going to do that? Of course, we are going to say that we are going to lock into the futures rate. Okay, so that we are going to say, well, despite the fact that the exchange rate will move and move and move, but we have locked into that rate in the futures market, so that's why we are going to create the futures create the outcome that will be almost the same if we were to use the $2 million converted into today's terms. Okay, so this is how the futures contract may work. Another question would be, you may have a question, well, Steve, if I'm going to convert that today in today's terms, it can give us 1,644,800. If I'm going to use the futures contract, it will give us a lower amount. Why does that happen? Well, this is what we call the imperfect hedge. So imperfect hedge, which means the result is not quite satisfactory. Why does that happen? Two reasons. First reason, basis risk. Because if you look at the working number 2 here, the changes in the spot rate, the changes in the spot rate is not equal to the changes in the futures price. So that's why this will be the thing. Okay, so this is called the basis risk. The second reason being that the number of contracts will be rounded to a particular number, but in this case it's okay because it's just to be 10 contracts, we don't have to round it up. But in most of the circumstances, because we are going to round it up, so let's say 11.2 contracts, we're going to round it up to 11 contracts, so that it will be not satisfactory for the final result, because this will be the imperfect hedge. But in this case it's okay, but the imperfect hedge creating two particular outcomes will be because of the changes in the spot rate that's not equal to the changes in the features rate. So this is called the basis risk. Okay, so this will be the basic concept behind the futures contract.